Hey everyone, John Henry here from School of Trade, and today we're going to be taking a look at trading the gap. Now, the morning gap, or gap trading, basically refers to the range between the closing price of yesterday, so as an example, the closing price yesterday was right there, and then the opening price of today. So in this particular day, we opened there, and the gap is the distance between those two distances. So that little area right there is what we're looking to be trading in. Now, in terms of the gap, you need to make sure that you have a charting platform that allows you to see gaps. We use NinjaTrader here at School of Trade, and NinjaTrader allows us to use different data series or session templates to display different types of hours. So as an example, gold opens at 8:20, closes at 1:30, that's all Eastern time. I can go into my data series, use NYMEX Metals RTH2, or regular trading hours 2, which is specific for gold and some other metal markets, and because I'm using that, when I go to my actual chart, we can see the opening time. If I hover my crosshair over there, the opening time is 8:25, so it means it opens at 8 o'clock because these are 5-minute candles. So 8:20, it opens up, and then it closes at 1:30. So it actually gets that gap for you. You can't use a 24/7 chart for this type of trading. So just keep that in mind. But looking at the different markets, you've got gold that opens at 8:20, closes at 1:30. You've got the E-minis that open at 9:30, close at 4 o'clock. And then you've got crude oil that opens at 9 a.m., closes at 2:30. You've also got a couple other ones like the bonds and notes. Those open at 8:20, close at 3 p.m. And also currency futures open at 8:20, close at 3 p.m. as well. So just make sure that you have a charting platform that allows you to display those specific session templates. Now, first things first, we need to find the gap at the opening bell, which is pretty easy to see on these session templates. We can see right off the bat, not difficult at all to see that there's a big gap there, there was a gap back there. It's pretty apparent. Some days are a little bit tighter and you're not able to see that gap as clearly. Other days you get very, very large gaps like we've got here. So typical gap trading, we need to make sure that we measure the size of the gap, which is the range between yesterday's closing price and today's opening price. Now remember that because you don't want to measure the top of the opening candle and the bottom of the closing candle. You need to actually measure from the yesterday's close to today's open. And it's a very important aspect of this. Now, we need to make sure that it really should be larger than 50 ticks, which will ensure that you basically have enough reward versus your risk on the trade. And that's kind of the key to this. Now, in this case, we measure from this close to this open. We have 52 ticks just inside the rule base, but we got 52 ticks, which is perfect. So now we know that there's a gap there. It does fall into our rule set in terms of size. Now we need to find the entry. So for an example, for a long trade example, we're going to look at a gap down at the opening bell. Now the reason behind that is we want to have an ability or the option to hop in on people who maybe were short back here or were stuck long, who all of a sudden they come in the next day and we're way down here. They're going to start exiting their positions because either they made a big bankroll of profit down here or they got stuck in a really bad position they need to liquidate, which is going to cause the market to rise higher towards filling that gap. And that's kind of the idea behind this trade itself. So looking at a 5-minute chart, and you can look at whatever time frame you want, but a 5-minute chart is pretty common when you're looking at these. The ideal candlestick that you want to see has a large wick or a big shadow on one side of it. Now, in this example right here, we can see that this first candle doesn't. It's actually a very bullish candle followed by a bearish candle, but look at the size of the wick on that candle. That's the big giveaway that we're getting rejection of those lows, and that's what you want to see. That gives you a big heads up that a rise higher is going to be imminent. Now, that rise higher might only be a little bit of the way, it might be the whole way, or in this case, it might be farther than the whole way. So you've got a lot of different options there, but just make sure that you're using the correct candlesticks. You want a big shadow on them. Now, we need to wait for this first candlestick to close, or in this case, the second candlestick, whichever candlestick gives you that big wick at the bottom there. And we need to enter long 2 ticks above the high of that first candlestick. So in this case right here, we never broke above that high, which is good. Then, we had this bullish candle, but we broke lower, had that big wick. Our entry is going to be 2 ticks above that candle. So our entry long, we'll just draw that up here. That's 92.3 right there. Of course, it won't let me draw it there, so let's just modify that a little bit. 92.3. So that's going to be the entry long right there. So now we know where we're getting long, but where do we place our stop loss? Where do our targets go? How do we actually manage this trade? Well, the stop loss is going to go right below the low of this candle. And again, you always want to give it a little bit of a buffer. You never want to put it smack at the bottom. That's never really a good idea. So the low here is 1290. We'll adjust that to maybe a brighter kind of a salmon color there so we can see it. Instead of 1290, we're actually going to go to 1289.8, and that gives us 2 ticks below that low. Just like we're entering 2 ticks with a buffer here, we also want to have 2 ticks below the low here just to give us enough room, just in case for whatever reason if price comes back down and wicks us out by 1 tick and comes back up, we don't get stopped out. We can still hold it for a little while. So now we're in long. We've got our stop placed. Where do we place our targets? Well, the profit target is going to be measured from the previous day's closing price to the opening price, just like we would measure the regular gap. And in this case, we want to measure using our little measuring tool here. We'll go from the close to the open, and we'll just draw right back up to the close again. The first target, and actually I think I drew that, yep, I drew that backward. So let's draw that again. We'll go from the open, rather, to the close, and then back to the open. There we go. So in this case, the first target is going to be the 38.2%. So right here is going to be our first target. Now you can see that doesn't give us a very big buffer in terms of the amount of space. So you do want to be a little bit kind of cognizant of how much space you have left. Taking a 38.2% here might not be the best idea. You might want to take it at the 50%, something like that. But the first target is going to be 38.2%. The next target is going to be 50%. And then the next and final one is going to be 100%, a full gap fill. Now we do have the 75% level on here for a reason. Once price gets to 75%, we're going to move our stop from 2 ticks below the low up to break even, just to lock out any potential chance that it's going to start reversing from there and stop us out at a loss again. So once we get those first couple targets taken off, we don't want any more risk on the trade, especially once we get to 75%. We're going to lock it right up into our stop right at the break even point. So you can see here, we gapped down at the open, and we opened on a very bullish note. We had a big wick at the bottom. That's a perfect signal for us to hop in long right there. Then immediately filled, if you wanted to take it that close, you've got the first target, second target, move to break even, and the final target. And you can see a lot of people were trading this because as soon as we tagged that 100%, look, it fell straight back down, a big old wick off the top there. So a lot of people were playing this gap trade on this specific day. So that's going to be taking a look at trading the gap. Very, very powerful pattern. And if you get the nice charting platforms that actually allow you to see this, it happens relatively frequently. So make sure that you can get a charting platform that works well with it. We use NinjaTrader, and it works pretty well. So that's going to be taking a look at the gap trade. If you have any questions about it, feel free to send an email to School of Trade. And don't forget to check out our trial at schooloftrade.com. Have a good one. Bye.